One of the few stocks that are actually not participating in this rally that we're having is actually Domino's pizza stock. This is a stock that's sitting at the same level it was sitting at in 2020. It's not rallying at all. The chart is very, very ugly. It topped out around $565 per share and now sitting at $298 per share. And I'm sure all of you know Domino's pizza. Maybe you tried Domino's pizza in your city or in your country. So we're going to discuss why Domino's pizza is actually not rallying with the market, and if this is actually presenting us a good buying opportunity on Domino's pizza, or is it maybe still a little bit expensive. This is what I'm gonna try to talk about in this video. Now, one of the reasons why, and this is the main reason why Domino's pizza has been performing poorly, is because every few years this company try to kind of put out their 2 to 3 year guidance. This was their 2 to 3 year outlook, and it was 6 to 10% in terms of sales growth over the next 2 to 3 years, but they revised it in December from 6 to 10% to 4 to 8%. And it's pretty bad for the company. I mean, when you go from 6 to 10% to 4 to 8%, of course, it's really going to damage your stock because all the DCF and all the valuation numbers have to adjust. And one of the reasons why I think this is happening is mainly because, again, Domino's is a little bit too big. There's not much expansions that Domino's can do, although they are doing a lot of expansions. And most of the returns are actually going to be coming from buybacks, which I'm going to discuss in this video. But yes, 6 to 10% to 4 to 8% is actually a big change, and it's something that's not good at all. Now, if we look at the company, for me to try to explain more where they make their revenues, they have some, company-owned stores where they manage the stores, and it's just managed like a regular store. But a lot of the revenue actually comes from franchising royalties, and this is the best part about the business because it's very high margin. I believe they collect 5% of sales from every single store that has their Domino's Pizza name on it. They make pretty good revenues from it, and the biggest source of revenue is actually the supply chain. This is actually where they pretty much sell the sauces and all the kind of any ingredients that are needed to do the pizza, to make them. They have them all within warehouses, within in-house, and they sell them to those franchises, and this is very low margin revenue. I'm personally not a big fan of this. I understand why Domino's done it, to be vertically integrated and keep the sauces and everything, within in-house pretty much. But I personally more of a fan in terms of the franchising and royalties, not much of the supply chain. But nonetheless, the earnings were actually not bad at all. They were much worse in 2022, but now earnings are increasing again after contracting in 2022, giving Domino's Pizza a net income margin expansion from 9% back to 10.2%, which is pretty close, to their historical average. So things are improving, but the company did get hit very hard from what happened after COVID, because whenever we had COVID, people were ordering out, either takeout or delivery. And as you know, you cannot eat within a Domino's Pizza type of, franchise store. You normally either has to, a takeout or delivery. And people were not doing a lot of takeouts and delivery after COVID. They were traveling, they were going out and doing a lot of things. So again, it's just, they've been suffering after COVID, and this might actually be creating an opportunity, and now things are starting to improve again for Domino's Pizza. Now, if we look at the balance sheet of the company, and this is a big concern to a lot of people that own Domino's Pizza. I talked with those people on Twitter, and they have $150 million of cash, which is not bad at all. But their long-term debt is pretty close to $5 billion, almost $4.9 billion. So pretty close to $5 billion of long-term debt with $150 million of, cash. And this is a lot of debt, pretty close to $5 billion. It's a lot of debt, and it's a concern to a lot of people. But I'm personally not very concerned with the debt, because if we look at the maturities of the debt, most of the debt expires in 2025, around $1.1 billion, and the rest matures in 2026, 1.3, and after in 2027 and after is somewhere around, pretty close to 2.4 billion, which means they are spread out over time. And I don't think this is a big problem for Domino's Pizza. But the main reason, the debt grew so much was because the company was using it to buy back stock at much higher prices, which was actually a big mismanagement from Domino's. As you could tell from the shares outstanding, they do go down a lot because the company focuses on buybacks. And this is something amazing. It creates value to shareholders, but the company was leveraging up to buy back stock whenever the company was trading at 35 or 36 times earnings. So it was very bad timing to be doing buybacks. This is the time, in my opinion, to actually be doing a lot of buybacks, but there's some concerns that because of the debt that Domino's Pizza actually have, they might not be able to buy back stock as much as they used to before, although now Domino's is trading at a much more attractive prices. And this is one of the reasons why the stock is coming down. But in terms of the debt, again, it's not a concern at all because the company has a stable, resilient free cash flow of around $500 million a year, and not much is maturing before 2025 and 2027. I'm sure from now on, the company can restructure it or do something, or it could even, save the money and pay it off. But if they save the money and pay it off, they're not going to be able to buy back stock or return any value to shareholders. And this is the big problem with Domino's. Now, if we look at how much Domino's is actually trading at on a historical basis, it's trading at 21 times forward earnings. Now, 21 times is actually, close to the mean. The mean was 24 times. Now it's still sitting at 21 times despite the huge decline in the company. It traded as high as 39 times and as low as 4 times earnings, and this was in the 2009 financial crisis. This is not going to happen anytime soon. But at 21 times earnings, below the mean of 24 times, Domino's Pizza is actually, not bad at all with such, high returns on capital, because the company has 60 or 70% return on capital. This largely came in from the buybacks that they actually made, but I personally believe it was a mistake of taking on debt to buy buybacks whenever, the stock was trading pretty close to 30 or 35 times earnings. Now sitting at 21 times, this is the time to be doing buybacks, but Domino's has some debt, which could be a concern to the buyback program. Now we're going to take a look into my evaluation model to determine and make our final decision to see if Domino's Pizza is a good buying opportunity at $298 per share, or if we should maybe wait for a better price. Now, for revenue growth, I use 6% revenue growth, and this is from the company's own guidance. We talked about 4 to 8% on their 2 to 3 year outlook. I used a middle number of 6%. I believe 6% is very fair. I used the same net income margins, 10%. I kept it at 10%. I used the 20 times earnings, assuming the company keeps trading at the same multiple it's trading at. Now it's around 21 times. I think 20 times is something fair for Domino's Pizza for the base case scenario. So 20 times earnings, I put a 5% dividend. It's not a dividend. The company normally buys back 4 to 5% of the market cap every single year. So even though they have more debt, I assume they're going to continue to buy back 5% of the market cap. Now, this could actually be wrong, and maybe they decide to pay down the debt, or they do something else. But I just kept it at 5% to assume that whatever was happening in the past is likely going to continue. This would only get us 41% on the upside, or 7.1% compounded every single year for the next 5 years, which is even lower than the S&P median, and it's not a good return at all. Now, if the Domino's Pizza actually gets back to 25 times earnings, which is the mean multiple, it was trading 24 to 25 on a historical average. But now Domino's has less growth than it had before, but assuming it gets back to 25 times earnings, in this case, you could be looking at 69% on the upside, or 11% compounded every single year for the next 5 years, which is actually not a bad return at all. I don't think it's a bad return at all in general. But if I personally want to double my money over the next 3 to 5 years, I have to buy Domino's somewhere around $220 per share. Now, $220 per share would be somewhere where it was trading at, pretty much below the COVID lows. And it's now pretty close to the COVID lows anyway. Now, I'm not sure if Domino's Pizza is going to, get there or not, but this is what my valuation model is saying. I don't think 20 times earnings is unreasonable. I don't think any of the growth numbers are unreasonable. So I would not be surprised if, Domino's trades at $220 per share, and this would be around a 25.5% decline from the today's prices, which I'm not sure if it's going to happen, but I'm personally going to most likely open a position in Domino's Pizza somewhere close to $220 if it ever gets there, maybe $230, $240, $250, but as close close as I can get to 220, I think Domino's Pizza would be a bargain. It would be an amazing buying opportunity, taking into consideration 20 times earnings. So this was no financial advice. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.